Still some more to join, but good morning, everyone. My name is Cam Goodenough, Managing Director, Capital and Partnerships at Hazelview Investments. Thanks for joining us today. As evidenced by the number of inbound calls we've been receiving, the new accounts we've brought on, and frankly, how many people are joining this call today, REITs are garnering a lot of investor attention right now. As our team will touch on, COVID has had a big impact on the sector, both real and perceived, and the arrival of the vaccine bringing with it a reopening of the economy is set to realign things once again. Hazelview's REIT team consists of 13 portfolio management professionals and analysts located in Toronto, New York, Hamburg, and Hong Kong. The senior team, which has been together 15 years now, have delivered one of the globe's top 10-year track records. The senior PMs, Corrado Russo, Sam Son, and Claudia Reich-Floyd, join us today and will take us through their 2021 Global REIT Outlook. If you have any questions, please enter them in the Q&A section at the bottom of your screens. We will address them at the end of the presentation. I'll now turn the call over to Corrado Russo, Senior Managing Director Investments and Head of Public Real Estate Investments. Go ahead, Corrado.
Great, Cam. Thank you very much. And thank you everyone for joining. Really appreciate your time today. I'm really hopeful it's going to be useful. We're pretty excited about 2021. Obviously, 2020 was a tougher year for all of us, and specifically for public real estate. And I think we're pretty excited about how the vaccine plays out and how the recovery story begins to play out in 2021. And we thought we'd share our thoughts on how we think it plays out and where we think the most interesting opportunities are going into the new year. So to start there, I'm just going to give a quick recap on 2020. Won't spend too much time on it. We've all sort of watched it play out. I'll talk about some of the outlook highlights that we put in our paper that got published earlier in the month. I just want to highlight some of the more important pieces, and then we're going to turn it over to Sam and Claudia to speak more specifically about our top 10 opportunities. And that's really where we want to spend a lot of our time, is just help you understand where we're excited, where we see some of the opportunities, and where we're putting our clients' capital going into 2021 and 2022. So to start with the recap, obviously, pandemic hit in Q1. We saw, unprecedented declines in the equity markets. Global REITs were not spared. They were down almost 43% during that period. As we came through to Q2 and Q3, we got massive amounts of fiscal and monetary stimulus, the likes of which we'd never seen before. And this obviously acted somewhat as a defibrillator for the economy, and frankly, more so for the stock market as things continued to recover in the general equity market, specifically led by the technology sector. REITs did see some recovery, but certainly continued to lag until really the fourth quarter, where we saw the vaccine. And that's really where you saw, given the high efficacy rates of the vaccine, as well as some of the election uncertainty that was removed from the market, saw REITs as well as the general equity markets gain, but saw REITs sort of keep pace and start to outperform, which we believe is sort of the beginning of what we'll continue to see in terms of a trend going into 2021. In that time period, global REITs were down for the entire year, minus 8.2%. This is in US dollars, while Hazelview was up 2.3%. And we'll explain why. And a lot of that obviously had to do with sector selection and where we put our capital, both pre-COVID as well as during COVID, and how we sort of, not only tried to protect capital on the way down, but got into sectors that we felt were going to do better through 2020. And obviously, our goal is to do the same for 2021. At the same time, though, we still remain well below the general equity markets. And I think that is one of the things that is the driving factor for us to believe that there will be a reversion to the mean, and we'll explain more on that in the next few slides here. Not only did we see one of the worst relative performance of public real estate in 2020, but we also saw the highest dispersion amongst the underlying subsectors of real estate. It truly was the K-shaped story during 2020, which many of us had read about through the year. And the same was true for real estate. If you look at some sectors within real estate, they actually did quite well during the pandemic and during the lockdowns and restrictions. So think areas like data centers, industrial, self-storage, cell towers, all of these sort of, restrictions on mobility and the use of data and online shopping and e-commerce really drove those sectors. And it's not a surprise to see some of the sectors at the bottom there: hotels, regional malls, shopping centers, office, that obviously were the most hurt by the restrictions and the inability for people to utilize bricks and mortar. And I think the question really is, how does this play out into 2021? Does this flip? Is it the inverse, or is there going to be a little less straightforward in terms of how things play out and how we sort of change or close that K-shaped recovery as the vaccines start to take effect? So moving to that, we wanted to start with, what is the macro backdrop for REITs and for real estate today? Obviously, we have a highly effective vaccine that's leading to a synchronized global economic rebound that's going to begin in 2021. Not necessarily that we think that it's going to continue to get right back to normal, although there are certain sectors that we believe could have some significant pent-up demand that get there sooner rather than later. But generally, we believe this global economic rebound will lead to the great REIT opening, as we coined that phrase in our Outlook paper earlier in the year. And so we are pretty excited about, again, the opportunities and the valuations and the growth prospects that we see in front of our sector that we haven't seen in the 15 years that we've been together, really since the financial crisis. And if you look, speaking of the financial crisis, if you look at the consensus estimates today for global GDP growth, it's around 5% for 2021. The last time we saw that growth rate was in 2010. And if you look at 2010, where we had a similar macro landscape in terms of expected GDP growth and fiscal and monetary stimulus, that led to REITs outperforming in that year by 800 basis points. And started an outperformance trend over the following 3 to 5 years. And then lastly, as we look at unemployment will continue to decrease in most economists' mind. And as we continue to see that reduction in unemployment, that's expected to be one of the strongest drivers for real estate across the board in many of the sectors. So how do we think about the different subsectors into 2021? How do we think certain sectors will play out? Will some rebound back to normal? Will some face longer term challenges? And so what we've tried to do is bifurcate our entire industry into one of 4 different categories. The first category being companies or sectors with very strong fundamentals, long-term secular growth tailwinds, and they're trading at reasonable valuations. So think sectors like industrial, think sectors like cell towers, where we think there's still a secular growth opportunity, and irrespective of the outperformance in 2020, they're still trading at valuations that don't fully reflect the intrinsic value over the long term. Secondly, you've got sectors with poor fundamentals that suffered in 2020, either on a real or a perceived basis, that we expect to experience a very strong recovery in demand, and they're trading at extremely attractive valuations. So we would put hotels in this category, for example, where we believe there's pent-up demand, especially in the leisure travel space, that could bounce back sooner rather than later. And then you've got good fundamentals, very strong tailwinds, but where you're paying up for that growth profile, where we believe the valuations are less attractive and are pricing in and forward paying for that intrinsic value or that growth over the long term. So here we would put things like data centers, where obviously valuations have continued to drive through NAV and where you're paying for future growth. And then lastly, you have sectors that are cheap, but cheap for a reason, and there we would put something like, for example, regional malls, where obviously demand was curtailed through the lockdown and the inability to shop in bricks and mortar. But if we look at the sector overall, we believe it had its challenges going into COVID, and we believe COVID only accelerated those long-term trends and challenges that they face. So we believe that malls with department stores or fashion-oriented retailers are going to continue to suffer from a loss of market share from e-commerce and may not ever get back to their pre-COVID levels, and may set some sort of new normal, which is obviously incumbent on us to figure out what that new normal looks like. So where does that leave us? If you look at what we are looking at for 2021, our expectation is if you look at the current levels of where we're trading, we're still 88% below pre-COVID level. That's obviously different than what you're seeing in the general equity markets or in the NASDAQ, for example. Global REITs, in our view, are priced at 25% discount to their intrinsic value. And when we talk about intrinsic value, we're talking about our forward-looking expectation of where value is going to be, not where value is today. So we do our best to try to put into that valuation how we think plays out, how we think things play out. What is the change in cap rates and the cost of capital driven by interest rates or inflation? What do we think demand supply is going to look like? How is that demand and supply picture going to impact occupancy and rent levels and capital expenditures? So looking at all of the different changes potentially in uses, for example, in office and regional malls, and think about how that might change value. That all goes into our intrinsic value, and we're still seeing a 25% discount to intrinsic value. That implies roughly 30% upside in price from today's level. And if we assume it takes about 2 years to get back to that intrinsic value, then that, together with the current dividends that the companies are paying, would equate to about a 15 to 20% annualized return over the next couple of years. And I want to put that 15 to 20% into context. If we were to get 15% gains from today's level over the 2021 period, all that would do is get us back to pre-COVID levels. And you compare that to global equities already trading at 10% above that level, and the NASDAQ 30% above that level. So we think it's a very achievable expected return and potentially could surprise to the upside. What is this predicated on? It's predicated on a few things. Obviously, valuations in our view are very attractive, and this represents a strong entry point. Investor sentiment has started to turn. The vaccine was a game changer in terms of the sentiment towards real estate as people turned from growth to value, and they turned to more of the recovery sectors versus the stay-at-home sectors. And we believe that's going to lead to a reversion of the have versus the have-not sectors, and something that we have to pay attention to. And in addition to paying attention to some of the sectors that will recover and have a reversion to the mean, we also want to continue to stay invested in sectors that have very strong secular growth trends, which we'll talk about. First, on valuations, a strong entry point. If you look at the multiples of REITs versus global equities, they are at their lowest level we have ever seen, lower even than the financial crisis. The financial crisis, which was driven predominantly as a real estate issue, more in the housing market than in the commercial real estate market, but certainly had real estate at the center of some of the issues back in the financial crisis. And yet we're trading at lower levels relative to global equities than we were even trading at back then. If you look at investor sentiment, again, this is sentiment back in October, and it's only continued to grow since we've gotten the vaccine back in November. Obviously, real estate is at the top in terms of how negative the view was on real estate in 2020. In our view, obviously, much more negative than the actual on-the-ground fundamentals and what was really happening. And we believe that sentiment and that perception is starting to change and will improve valuations going into 2021. This just highlights the multiples of the haves and the have-nots, so some of the most hurt sectors versus some of the help sectors or some of the sectors that continue to have good secular growth. And we've never seen this kind of dispersion. And obviously you can see towards the end of the year there that started to reverse. So we've got to pay equal attention to certain sectors that may have had poor fundamentals in 2020, but will have improving fundamentals, will be the most improved players going into 2021. And that's obviously going to be a part of what we're going to be putting into our portfolios on behalf of our clients. But in addition to that, there are some significant growth stories, key themes that we believe have great tailwinds and have the ability to deliver outsized earnings growth over the next 3 to 5 years. And many of these are trading at what we believe are reasonable pricing that don't fully reflect that growth optimization. And this is sort of going to be, if you can think of the other half of the portfolio. And this includes, e-commerce and supply chain optimization, think industrial and as online sales continue to grow, the convergence of technology and real estate, so data center cell towers as we continue to have the proliferation of 5G and the demand that's going to lead to in terms of data usage, growing demand for affordable residential housing. This is an issue on a global scale. We have a shortage of affordable, good quality housing for our people around the world in many markets. And if we can find companies that can be the solution to that, whether it be manufactured housing communities, single family rental, or mid-market multifamily companies, we believe that that will continue to have good growth over the long term. And the gentrification of a trend to smaller, more efficient uses as we continue to have smaller living quarters and we continue to utilize that space differently, whether it be for work at home or other uses, we're going to need to more efficiently use our homes, and that's leading to strong demand for things like self-storage, for example. And then lastly, there is an underlying growth in some of these specialty trends, whether it be things like gaming or cold storage, life sciences. We believe that they are still in their infancy, and that infancy is creating a lot of growth and consolidation opportunities for these companies. And we believe that will lead, again, to stronger growth. So with that, I wanted to turn it over to Sam. He's going to walk you through where we see the current fundamentals. We look at the entire world differently. We have different countries and sectors. He'll walk you through what our view is there and then get into our top ideas.
Thank you, Corrado, and good morning, everyone. As you can see from the slide, not every region is going to experience, in our view, strong fundamentals in 2021. And it's simply not enough to say we are positive on residential or self-storage or one sector compared to another sector. The opportunity set for each sector will absolutely vary by market. In our mind, the best opportunities in 2021 are shown in green. The red dots are areas of the market we tend to avoid, and you have to be careful in the yellows. Lastly, this is why you want active management, to be able to identify the segments in the market that will experience strong returns and create alpha for investors. Corrado, if we flip to the next slide. What you see here is our top 10 investment ideas for 2021. We take a bottom-up approach to identifying which companies within each property type and each country are poised to outperform. A few examples you see here include data centers in Hong Kong or multifamily properties in Canada. What we thought we would do next is go into more detail about each of these 10 opportunities, starting with the top row from left to right. So allow me to turn the floor over to Claudia, who's going to discuss how cell towers are benefiting from secular tailwinds driven by 5G.
Yes, thank you. So on the cell tower sector, you saw earlier that where Corrado was showing how they did very well already in 2020, but we continue to see strong growth opportunities for the sector. The yields are still higher than in traditional real estate sectors, and at the same time, the growth opportunities are very strong. And that is mainly based on increased data consumption, which I'm sure all of you are aware of, but mainly the global rollout of 5G. And we expect a very strong year for 2021 as well. I think the most important part to point out is that because REITs are set up to be excellent partners for the wireless carriers or the telco companies, they really have a value add over other investors on this side. So they can be strong partners, long-term partners. They are able to really grow the portfolios with them. The CapEx needs are strong, and in Europe, you're even in their towers, and they need also, of course, a strong long-term partner, and that long-term partner can be really a cell company more, a cell tower company more than a private equity player or just an individual institution, because they come with a very strong expertise. So the buying opportunities that are all accretive because they are buying at prices that enables them to improve their cash flow, at the same time enables them to show stronger margins going forward because they can lease up to more users, really defines this growth opportunity going forward. So bottom line, we see this as category one. It's a strong fundamental dynamic And we still continue to see attractive pricing opportunity.
Thank you, Claudia. In 2020, self-storage proved itself to be a recession-resilient property type, delivering positive total returns in North America, in Europe, and Australia. Occupancy rates increased in most markets around the world, and street rates started to recover in the second half of the year. As we head into 2021, demand for self-storage is accelerating, driven by a vibrant housing market, more people working from home, and secular demand factors such as businesses that are using the product as a quasi-last-mile access point to consumers. In the US, street rates are increasing at double-digit rates, with companies reinstituting rent increases on existing customers. In the month of December alone, spending on self-storage facilities increased by nearly 20%. In Europe, demand, occupancy, and new move-in activity is exceeding pre-pandemic levels in markets like the Netherlands, Sweden, Germany, and Denmark, with rent collection rates approaching 2019 rates. Finally, in Australia, we believe there is upside in margins driven by a continued improvement in higher new move-in volume and lower move-out volume, which should drive occupancy rates higher, in our view, into 2021, ultimately leading to higher cash flows, higher asset values, and cap rate compression, which should positively influence share prices in the public market.
Yes, along those lines also goes industrial or logistics. We have seen an acceleration of demand for logistics space in 2020, although during the corona pandemic and some of the lockdowns, some of the contract logistics had seen some issues, maybe with supply chains, etc., and maybe there were some hiccups, but all of that was compensated mainly through demand from e-logistics, and not just from Amazon, but across different retailers, across different companies that are trying to reach the consumer and are trying to change maybe also their business models. They usually have a very high demand for automation. That's something that's been pushed forward by several years now. And that also means that high quality space is especially in demand, and you have really a lack of supply in specifically that category. And that means that with low supply, really very limited opportunities to, and I'll talk about that in a second, of new supply. You also have increasing rents, especially in urban locations or where you're close to the consumer, where you can guarantee the next day delivery or very close delivery is in high demand. And in North America, we already saw over the last couple of years strong growth in rents. That has also reached Asia and Europe this year. And one thing I wanted to touch on as well is really the supply. Supply is getting harder and harder to deliver. Really, the yield spreads for new developments are very attractive for those who have access to land, who get permissions, and the REITs are able to secure that early on and have very good relationships to take advantage of that. Because also, and that's specifically in Europe and Asia again, your land supply is getting smaller and smaller because green energy, biodiversity, etc., is restricting more and more developments, meaning even if you would want to develop, that is not possible, or you get pushed into secondary locations even. So we are seeing strong opportunities in certain pockets specifically, because one does have to say that prices are in certain instances high, but we do see pockets of opportunity in North America, specifically also in Canada. And in Europe, we are, for example, playing the Nordic region, where we are still far behind the curve on e-commerce, and that's really ramping up. They also are very strong in the tech industry, so we see more supply coming from that part of the sector. And in Japan we also see a standout industrial market for 2021, simply due to strong absorption, again, e-commerce, but also a very limited supply.
Thanks, Claudia. No other sector has been impacted by COVID-19 as badly as the lodging industry. Travel restrictions and forced lockdowns have decimated cash flows and necessitated covenant waivers from lending groups who are working with owners to get to the other side. As we turn to 2021, we see light at the end of the tunnel. People want to go back to their pre-COVID lives. They want to socialize and they want to travel. We are of the view that multiple COVID-19 vaccines will serve as the catalyst to unleash a significant amount of pent-up leisure, business, and group travel demand. In the US, we believe leisure travel will be first to recover, with limited service hotels in suburban, drive-to locations, and resorts in coastal areas benefiting the most. We expect a recovery for hotels in central business districts around the world that rely on group business and inbound tourism will be slower to recover. Although the pace and timing of the recovery will differ by market and hotel type, so for example, upper upscale versus economy, we expect margins to be higher next cycle than this cycle, as owners and operators have turned to zero-based budgeting to maximize profitability and lower levels of occupancy. Lastly, we believe we will see sequential improvement in RevPAR growth starting in 2Q 2020. That goes for Asia, Europe, as well as North America, which should positively influence share prices as the year progresses.
Thanks, Sam. I can't wait to fly to a hotel like that soon, being faced with the Hamburg winter. So open air retailers is another sector that where we see a lot of opportunities. Clearly, this is also a very resilient investment space. What we saw in 2020 was that retail in general was performing very poorly because everything was just thrown into one bucket. Now we come out of it, and it was very clear already after certain lockup phases were eased or limited during the summer that especially these open air retailers recovered. The sales ratios of the tenants were above prior years, and it was very surprising how strong the consumer went back, especially to those areas. But as another part of the equation, longer term or looking longer term, of course, you have their services or also grocery stores that have a bit of a touch and feel element to it. So, or you can't replace them with really the online sales argument. So you do have a more resilient long-term perspective for these locations. And on the other hand, you can very much think going down the road as this is a hybrid model. So kind of what IKEA maybe has already had for a long time, where you can do pickup, but you can also go and shop inside. This is also very likely to happen with a lot of the retailers that are not service retailers within those locations that will, or that already have implemented click and collect, and that are very likely to extend that even further. I was just on the phone with a charging station operators. They are also, for example, likely to cooperate with that. So where you use that in conjunction of having to wait for 20 minutes to charge an electric car. All these longer term perspectives speak for this type of retail element. And we do think that, especially at this current pricing opportunity that exists in a lot of different countries, this is something where it's a good time to step into. Sam, over to you.
Thank you. In 2020, COVID had a profound impact on residential markets around the world, increasing demand for affordable housing solutions with work from home capabilities. In 2021, we are positive on the residential sector, but particularly in Canada and the US, where we see a disconnect between public and private market valuations. We believe the Canadian multifamily sector is poised to deliver attractive shareholder returns in 2021, led by rising household formation, the unaffordability of home ownership, which is creating a swelling pool of renters, and favorable immigration policies that will further increase demand for housing in the years to come. In the US, we also have a favorable view on all three segments of the for-rent market: multifamily, single family, and rental and manufactured housing. In the multifamily sector, we are beginning to see green shoots form, particularly in suburban locations within coastal communities, as move-in activity has recently exceeded move-outs, leasing traffic and site visits are rising, early terminations are abating, and rent collection rates remain strong. We also believe single-family rentals are poised to deliver strong top-line and bottom-line growth in 2021, driven by gains in occupancy and increasing renewal spreads as leases expire and renew, with COVID-19 accelerating demand for housing outside of city centers in good school districts. Finally, manufactured housing, which offers a more affordable price point, has thrived during the pandemic, and we believe that trend continues in 2021.
So one of the most probably controversially discussed sectors is offices. We do think that there are opportunities for investments in the office REIT space that, however, have to be looked at in detail. We feel that especially last year, everything was wrapped into the same context. And that was the work from home trend, and everybody had to really work from home during the Corona pandemic. But that there are very big differences within each market, I think, is already visible within our team. We have a team that already works a lot from home or remote. We have satellite offices such as Sam in New York, I'm in Hamburg, we have two guys in Hong Kong. And they don't really even have the need to see a team, so to say, at the office. But still, you know, you have to really differentiate. Sam has an over an hour commute into a city where you have high rises, where you have to go through the public transportation, and that is currently the biggest challenge. He has, I think, not been back to the office since March. And that's exactly the challenge that these kind of cities and locations are facing at the moment. At the same time, I'm located in Hamburg. I have a 20-minute commute. I can drive with the car and park outside. I work in the 6th floor, and our office rents are probably a fourth of what you have in New York. And for me, it's an escape to get another sandwich or to just see some people on the street to get out of the house. And that will not change just because I can work remotely. And in Germany in general, you can say that there's a lot of businesses that can't even work remotely. So you have a totally different mixture of tenants, and the demand will change in a different way. We have done our own research, even including a university, to question employers and employees. And I think the outcome was pretty clear that maybe in a worst case scenario, and I'm speaking mainly about kind of the second location where you are not facing the high rise or so, is maybe the worst case is maybe 10% demand potential that could go away. But then you have to think about that doesn't happen within a year. It takes time to plan, it takes time to figure out, and that even means people have to share desks. It means that you can divide those maybe 2 days a week that they want to work from home, so that it's not all at the same time. You want to still meet people. So I think bottom line, we come to the conclusion that especially high quality space where people like to go, where it's not a huge burden for the employer, there will be a strong demand to return back to the workspace. And we think that therefore, especially high quality space in good locations will really prevail, and will see still very attractive rebound potential. which is where we are placing our investments. We are still a little bit cautious on places like London, where we also see the headwind from Brexit. You maybe have heard that they have lost a lot of their trading business from day one of exiting the EU. So that will have a longer term impact also for the city, and there's still a lot of unknowns. But there's also places in Asia and Hong Kong where you have such a small apartment that people just have to go to the office or want to go to the office because they can't really facilitate working from home. So we do, like I said, we do think that at these discounts that we are currently seeing in the market, from 5 to 25% to the last gross asset values, there's opportunities that can be taken, and we have been stepping in, and we are stepping in still to take advantage of that.
If I can just interject for 1 second, we've got a couple more to go on the opportunities list. If I can ask anyone to just sort of start putting in your questions, feel free to type them into the Q&A there, and we'll get to them as soon as we're finished the last couple of opportunities here.
Thanks, Corrado. COVID-19, similar to other sectors that are more cyclical in nature, has had a disproportionately negative impact on seniors and the facilities they live in. Globally, nearly 1/3 of all COVID-19 fatalities are tied to residents living in nursing homes and senior housing facilities, which in and of itself is just an outstanding statistic. Since the start of the pandemic, occupancy rates at US senior housing facilities have declined by over 700 basis points, driven by higher move-out volume and lower move-in volume as facilities stopped accepting new patients. We believe ultimately that peak to trough decline will be somewhere around 10%. Prior to the most recent surge in COVID-19 cases starting at the end of October, the rate of deterioration in occupancy was actually materially improving as facilities reopened their doors to new residents. Monthly rental rates have stayed relatively steady despite the decline in occupancy, and occupancy rates had started to improve. And we think once they start to improve, that should lead to a recovery in margins in 2021. We believe the vaccine, similar to hotels, will serve as a positive catalyst to unlock a wave of pent-up demand from families that have delayed decisions with regards to the future living arrangements of their loved ones. Now, as we move through and into 2021, we believe move-in activity will improve, move-out activity will slow, leading to a strong recovery in occupancy that will be more pronounced in the second half of the year. Lastly, we believe COVID has not changed the long-term secular need for senior housing facilities as the baby boomer generation continues to age into that 75-year-old plus cohort.
Thanks, Sam. So moving on to data centers, again, something that obviously did well in 2020 already, but we do see the strong secular growth here still outpacing the price movement that has happened last year. We do see the high level of automation that we are entering, not just on the personal level, but also from a corporate level. I think we're still at an early stage of corporates and production facilities using artificial intelligence, the Internet of Things, etc., and also talking about self-driving cars, etc., etc. There is a huge demand that is likely to ramp up over the next years, and the global leasing volume has already surpassed 500 megawatts last year, also mainly as hyperscale and cloud service providers are rapidly expanding. So we do think that REITs specifically can also add a lot of value add on top of the market dynamics because they have a strong expertise. Again, this is something where you do have a strong partnership with your tenants, and you do have to understand all the different moving pieces within each market. So electricity demand, and as well as where are new submarine cables coming in. There is new hubs that are establishing itself where you do want to get in early to acquire land, where certain players want to be positioned. Just as an example, on the energy use, from today, where data centers make up about 1% of the energy use, in 2030, we will see 8% of our global energy use most likely come from data centers. That also puts a lot of pressure on where is this energy coming from? Is it going to be from energy that is coming from wind and solar or hydropower? And governments trying to implement more restrictions on that. Certainly, you have to think about that as a data center provider and a landlord. So we do think that the REITs are positioned in a very good way with their partners for growth, but also for the existing centers already. In Asia Pacific, for example, we have an investment that sits on top of really 13 international submarine cables and then 17 overland cables to China. This is a hub that is not likely to go away. And like I said, the demand is increasing. So the partnerships you're developing with those tenants will help you grow long-term in different regions. So our investments currently are mainly in the US and Asia Pacific, although those REITs are also international, so they also have investments in Europe. And we are always monitoring if there's opportunities also directly in Europe. At the moment, this is more through logistic providers, but like I said, we prefer really the specific focused data center REITs because they can add another level of value for the investors.
Okay. Last but not least is we see an emerging group of institutional property types that are poised to shine in 2021, such as life science, cold storage warehouses, and casinos. We believe life science real estate serves a critical role to bioscience, diagnostic, and pharmaceutical companies focused on solving the world's diseases and health problems, including COVID-19. Tenant demand for life science lab and office space is strong, particularly in major markets such as Cambridge, San Francisco, San Diego, and Toronto. Cold storage facilities as another emerging institutional property type that we see within the industrial warehouse sector. Temperature-controlled facilities are critical for customers in the food industry. Think of frozen packages, frozen foods, poultry. We see upside from operational improvements and technology initiatives leading to margin expansion in 2021. Casinos are another niche-oriented, often overlooked segment of the real estate market that offers attractive secular growth potential. From the owner's point of view, leases are structured in a very favorable manner with highly visible rent growth and low maintenance capex. What that does is it results in high cash returns to the owner, to the investor, and in our view, leads to attractive earnings growth over time. REITs have a competitive advantage relative to its private market peers as the buyer of choice, since they can use partnership units to solve complex tax situations and increase the pecking order in where they rank in a buying process. We believe there is a robust opportunity in 2021 for REITs to consolidate the ownership of gaming properties as COVID-19 has created dislocations within the marketplace. That's the end of my prepared remarks, and what I'm going to do now is turn the floor over to Corrado for Q&A.
Great, thank you, Sam. So just want to remind everybody again, feel free to go into the Q&A box there or in the chat and type any questions that you have for us, and we'll be happy to answer anything that you want to talk about. I do have a couple here that have started to come in. Maybe Claudia, I'll ask you to answer the first one. The question is, how would you rate barriers to entry in various segments? This question was triggered from something that was mentioned about self-storage, where we're seeing a very high level of pricing power with respect to landlords and self-storage. So the question is, how easy is it to build versus, say, cell towers, which have high barriers to entry? So maybe just explaining how the difference is in terms of ability to build and why they have the pricing power.
Sure, happy to take that. So I think that's a very good point. That's why we as a team have actually looked for more and more investments in specialty property types over the last years already, which is also why we do have some of this outperformance. Because especially in those specialty property types, your barriers to entries are higher. And I would say the other phenomenon, or the other thing that we've always seen throughout and after a crisis, or still within a crisis, such as this, where you have to gain market share, etc., REITs have actually been able to manage these crises a lot better because they have a very long-term focus really within their structure. They don't need to sell today or tomorrow. They don't have really that pressure unless they are financed wrong, and that's something where we wouldn't invest in. And so that's really a value add that they have. But maybe coming back to the different sectors, yes, cell towers is certainly very hard to enter. It's a high barriers to entry, and that it's even hard to enter for foreign competitors shows the recent transactions of American Tower, who paid a multiple of 26 versus cell towers just a couple of months ago paid a multiple of about 16. So that entry into the market cost American Tower significantly more money because it's not so easy to gain this market share. And that's why I think we also really prefer some of these players. Yes, and self-storage, again, there, what you are really benefiting from as a REIT or as a larger platform is that you have the economies of scale. Once you build out, and this is again where tech also comes into play, where you build out a pricing algorithm and everything within your whole structure is based on this technical expertise or this pricing opportunity and expertise, and you can really improve your margins significantly. This is why this is very different than if you just have 10 storage units. Yes, of course, you can run 10 storage units and they probably give you a good yield, but if you look at these platforms that have hundreds, they can realize much different margins, and they also pop up on Google at #1. So again, high barriers to entry. I think for logistics, there it really depends. There are certain areas that are low barriers to entry, but there's also, like I said, the level of automation and the demand that tenants have is increasing. So you have also increasing the high barriers to entry. Sam was also mentioning cold storage. I think you can also add that, where you maybe also, like in the US, offer delivery between the warehouses in cold trucks, etc. That's also part of it. So that is not everybody can do that. Can reason at a reasonable price do that. And I think, for the traditional property types, it's I guess a bit more known. Hotels, it's certainly that's been a market that's constantly changing, right? We even look at things like Airbnb to understand what's the market doing, where is it going. So I think the entries that are fluent, it's hard to say. And here again, I would say it's more about being able to spend the CapEx in the right way and understanding how you can really operate in a challenging environment that gives you the value add and that makes the barrier, so to say. Open air retailers, yes.
Oh, sorry, I thought I was just going to move on to the next question. It's okay, finish up.
Yeah, sorry, I don't want to take too much time, but yeah, open air retailers, I guess you have a little bit lower entry, but like I pointed out, I think what becomes more clear is also that land is becoming more scarce, and that infrastructure is a challenge, and as people might become less mobile in certain ways, locations become even more important. And therefore, I would say it's also established locations have again gained in importance. Multifamily, again, very market specific. I wouldn't want to say that in a general way.
Yeah, and the only thing I'd add, obviously, the question is predicated around just understanding and paying attention to supply versus demand, right? It's sort of first adage of real estate. So I think the point being, as we underwrite where future intrinsic value is, we want to understand how demand may be absorbed by supply, which is obviously potentially limiting rental growth over the long term. So I think it's a great question. As Claudia pointed out, it really depends on the specific geography in the region and the sector, but that obviously is a factor in underwriting our intrinsic value. Second question, maybe I'll turn it over to Sam. Do you see malls and office space transitioning to another sector? What is involved in this process and what are the timelines? So I think they mean repositioning into other asset classes, like, for example, residential. Sam, if you want to take that question.
Sure. I'll start with the office piece first. I think the short answer is no. Companies are in the process of figuring out their leasing decisions, their space decisions. And, sort of our view is that no, office properties, will remain in place. Companies may have less people in the office at first, but they are going to need their entire footprint to do it because of space restrictions, social guidance, guidelines. And, we think office will continue to be a mainstay within the commercial real estate space. In terms of the malls, the answer is probably yes, but it depends on what market you're talking about. It depends on the quality of the asset, and it depends on the location of that asset within the market. So a couple of quick examples. If you take your C or D or B minus mall in a market with 3 or 4 other malls, then yes, we think over time there's going to be sales declines, there's going to be tenants that are going to leave, there's going to be REAs that are going to be triggered, and that mall, most likely than not, will ultimately transition to another property type. And we're starting to see that already happen, in particular in the US, because the US is over-retailed. So we're seeing actual tech companies buying malls and thinking about repositioning into office, as an example. Residential shows up a lot. And if you think about the mall, it was already transitioning to an entertainment-oriented type of facility anyway. In Europe, and Australia and Asia, less so the case because grocery stores are already a large component of the mall, and space per capita, like i.e. new supply, is a lot lower as a percent of total stock. So we see that less of a transition to other property types than, let's say, in North America, where even in parts of Canada, you may see that D mall that is deteriorating, that is anchored by department stores or driven by apparel sales, that could more likely than not over time transition to another property type. So it's very market specific, and it's very based on the quality of the asset and the number of malls within a specific market.
That's great, Sam. Thank you. And we've got next question here. With REITs discounts, do you foresee privatization of some REITs? It's a great question. I'm happy to take a stab at this one. There's 2 ways to really look at this. I think first off, the answer is yes. In our view, we believe probably the biggest disconnect in publicly traded REITs right now is what's happening in the private market. There still continues to be a ton of capital that is raised from private funds, private companies, institutions, pension funds, insurance companies. The need for income has not gone away, and it's only become more challenging to get those fulfill those needs through fixed income. So you've seen lots of capital that's gone into real estate, and that real estate capital is looking for a home. When we talk to our private team and we talk to other private players in the space, they're actually finding it more difficult to find good quality assets. And obviously, when you've got very high quality portfolios trading in the public markets at significant discounts, that would certainly be a target. So I do think you will see some of that, but I also believe that is why you will see REITs gravitate back to those NAVs or those long-term intrinsic values. You know, we get asked all the time, are REITs real estate or are they equities? And the answer really is they behave more like equities in the short term, but they behave like bricks and mortar over the long term. And what I mean by that is if you were to draw a line of net asset values for bricks and mortar, REITs gravitate towards that trend line over the long term. And it's because of this question. When REITs trade at significant discounts, if they persist for any period of time, you typically have private capital, which dwarfs the size of publicly traded real estate, which is different than most other sectors, come in and acquire these assets on the cheap, and that generally closes that discount. And we believe this time is no different. Obviously, it depends on the region. In North America, in Australia, in the UK, for example, it is very open shareholder agreements and easy for private players to come in and acquire those assets. There's no poison pills, there's no family controls. And as you get into other parts of Asia, for example, or Hong Kong, where there is a lot of family control and poison pills, it might be a little difficult. So those discounts may persist for longer periods of time. So you have to be a little careful when you see very large discounts in a place like Hong Kong that may have a tougher time surfacing that value versus in places like the US, Australia, Canada, and even parts of Europe, where it is easier to surface that. So, I think that's a long-winded answer of saying, yeah, we believe that will be part of the story over the next couple of years as private capital looks to acquire some of these publicly traded REITs.
Yeah, I think what is still holding that back currently is the travel restrictions. So capital allocation decisions are delayed.
I think it's a great point. As people can go and tour assets, meet with management teams, get a touch and feel, which is part of their investment process, that you'll see more and more of that going into the back half of the year. So I see that's all the questions for now. Obviously, if you have any other questions that you want answered, feel free to send those in, send them into your sales associate, sales rep. We'd be happy to answer any questions. We're an open book. Hopefully you enjoyed our Outlook report and enjoyed this summary of that and some of our opportunities. Just want to reiterate how excited we are about the opportunities for REITs. We haven't seen this potential upside in earnings and value really since the financial crisis. And, I'll show the age of the team here and frankly, how long we've been together, because we were all together at the financial crisis. And so we continue to believe that this is going to be an exciting period for us. We're obviously hopeful that the vaccine will reach as many people as possible, not only obviously from our industry perspective, but from a human perspective, that we can sort of stop the restrictions and the impact on lives that we've seen to date. So with that, just want to thank everybody again for your time. Really appreciate you taking the time to listen to our story. And we hope to continue to be partners over the long term. So thank you.
Thank you.
Thank you, everyone.